Welcome back to the deep dive. We like to dig into research and data here, and today we're going to do a deep dive into a paper that I think will change the way you think about global stock performance. I think this is going to be especially insightful for the professional investors in our audience.
Oh, yeah, absolutely.
So we're going to be unpacking a research paper called Long-Term Shareholder Returns, Evidence from 64,000 Global Stocks.
Wow, that's a lot of stocks.
It is a lot of stocks. It covers over 64,000 stocks across 42 markets.
Okay.
From January 1990 to December 2020.
Wow,
So we're going to break down the key takeaways and what it means for your investing strategy.
sounds good.
What I think is so striking about this research is that it goes beyond just average market returns,
Right.
and it really dives into the distribution of those returns, which reveals some really surprising patterns.
Yeah. For instance, you might assume that most stocks perform well over the long term, but the data tells a different story.
Hmm.
Yeah. More than half of the stocks analyzed both in the U.S. and globally actually underperformed one-month U.S. Treasury bills over their entire lifetime in the market.
Okay, so more than half underperformed one-month T-bills. That's a pretty sobering statistic.
Yeah.
It kind of challenges the conventional wisdom that investing in stocks is like a guaranteed path to wealth creation.
Right.
So I'm guessing there's more to this story.
Absolutely. While a majority of individual stocks underperformed, the global stock market as a whole generated an incredible $75.7 trillion in net wealth between 1990 and 2020.
Wow, that's a lot of money.
And here's the kicker,
Okay.
just the top performing 2.4% of companies accounted for all of it.
So a tiny fraction of companies driving the entire engine of global stock market wealth.
Exactly.
Wow, that's wild. It really highlights the uneven nature of market returns.
Mm.
Makes you wonder if simply trying to mirror the overall market is the right approach.
Yeah, and that's a key question we'll explore later when we talk about passive versus active investing. But before we get there, let's break down these findings further. When we compare U.S. and global market performance, we see that non-U.S. stocks showed even stronger positive skewness.
Okay.
In practical terms, that means that outside the U.S., an even smaller percentage of companies were responsible for the lion's share of wealth creation. In fact, only 1.41% of non-U.S. firms generated the entire $30.7 trillion in wealth created outside the U.S.
Oh, even more concentrated outside of U.S. markets.
Wow.
It makes you think twice about diversification strategies. If just a handful of companies are driving the bulk of returns, spreading your bets across a wide range of stocks might not be as effective.
Right.
So let's delve into what this research tells us about the characteristics of those long-term winning companies.
Sure.
Does the paper give us a magic formula for picking winners?
Well, it doesn't give us a magic formula, but it does offer some interesting clues. The researchers emphasize the importance of looking beyond average returns. They talk about understanding the shape of the return distribution. Specifically, they point to this concept of skewness. This basically measures how much the return distribution leans to one side.
Okay, so let's break down skewness for a minute, because I know that's kind of a technical term. Can you
That's right.
explain that for investors in plain English?
Sure. Think of it like a lottery. Most people buy a ticket hoping to win the jackpot.
Yeah.
The vast majority lose, but a select few win big. This skews the average winnings upward, even though most people don't see those outsized returns. In the stock market, it's similar. Most stocks might underperform, but those few superstar companies, the ones with highly skewed returns, can drive significant wealth creation for those fortunate enough to hold them.
Okay, that's a great analogy. That helps visualize the concept. So are you saying investors should be looking for companies with the potential for those lottery-like explosive gains? Is that even possible to reliably identify?
That's the million-dollar question.
Yeah.
And it's one we'll tackle next. But first, let's take a closer look at what this research means for your investment strategy, especially when it comes to this debate between passive and active investing.
Okay, so we've established that stock market returns are highly skewed, with a small percentage of companies driving the majority of wealth creation. So does this favor active investing, where you're trying to pick those winning stocks, or passive investing, where you're betting on the overall market?
Right. It's an interesting debate, and this research provides some pretty compelling food for thought. On the one hand, the concentration of wealth creation in just a few superstar companies might suggest that passive investing, which aims to mirror the broad market performance, could miss out on some of those outsized returns.
Yeah, that makes sense.
If you're tracking an index that includes hundreds or even thousands of stocks, your gains could be diluted by those underperformers.
Yeah, but isn't picking those future winners, like, incredibly difficult, even for seasoned investors?
Absolutely. It's not easy.
Yeah.
The paper actually ran simulations to test this, and they found that even with a diversified portfolio of 100 non-U.S. stocks, the chances of beating the value-weighted market over a 31-year period were only 45.4%.
So even with careful diversification, no guarantee you'll outperform.
Right.
Hmm. So active investing is far from a sure thing. It seems like we're stuck in a dilemma. If passive investing might miss out on those big winners and active investing is so difficult, what's the best approach?
Well, this research doesn't offer a definitive answer, but it definitely highlights the trade-offs involved. Passive investing offers that broad exposure to the market at a low cost, but it might limit your upside potential. Active investing, on the other hand, offers the possibility of outperforming the market, but it requires a lot of research skill and tolerance for risk.
So I guess there's no one-size-fits-all solution. Really depends on your individual goals, risk tolerance, and time horizon. Let's go back to those superstar companies for a second. Is there anything investors could look for to try to identify companies with the potential for those explosive skewed returns?
Well, there's no foolproof method, but the paper does point to a connection between short-term volatility and long-term positive skewness. Basically, companies that experience more ups and downs in their stock price in the short term might be more likely to generate those massive outlier gains in the long run.
Oh, that's interesting. So almost like a counterintuitive point.
Right.
Wouldn't you want to invest in companies with like steady, predictable growth? Why would you seek out volatility?
Right, it's a valid concern, and volatility definitely implies risk. But think about it this way. Companies that are disrupting industries, introducing groundbreaking technologies, rapidly expanding into new markets, they often experience a lot of uncertainty in their early stages, and that can translate into volatile stock prices.
So you're saying we shouldn't shy away from volatility altogether. In fact, it could be a potential indicator of future growth, especially for those companies that are pushing boundaries and disrupting the status quo.
Exactly. Imagine two companies, Company A and Company B. Company A grows steadily and predictably, delivering consistent but kind of modest returns. Company B, on the other hand, has these wild swings in its stock price.
Okay.
Periods of rapid growth followed by sharp declines. So Company B might seem riskier in the short term, but if one of their bets pays off massively, you know, think of a groundbreaking product that just takes the market by storm, then it could end up outperforming Company A in the long run.
That's a great illustration. So instead of viewing volatility as something to avoid at all costs, it could be a potential signal of future growth, especially in those companies that are innovating and disrupting the market.
Exactly. But it's important to remember that not all volatile companies become superstars. There's plenty of companies that experience volatility but never achieve those huge gains. That's where that rigorous company analysis comes in.
Right. So it's not just about chasing volatility for the sake of volatility.
Yeah.
You need to understand what's driving the company's performance. What are they doing that could lead to those outsized gains?
Yeah, absolutely. And the paper really emphasizes the importance of making sound buy and sell decisions, not just based on those short-term price movements, but on a deep understanding of the company's long-term potential for value creation. They actually looked at wealth creation, not just in terms of market cap. They factored in dividends, share buybacks, and new equity issuances to give a much more holistic view of how companies are generating value for their shareholders.
And they even provide some interesting examples,
Yeah, they do.
like Apple, which generated an enormous amount of wealth,
Yeah.
and PetroChina, which actually destroyed shareholder wealth.
Exactly. So they highlight Apple, which created $2.67 trillion in wealth,
Wow.
representing a pretty significant portion of global wealth creation. And on the flip side, there's PetroChina, which destroyed over $553 billion in wealth.
Yeah.
And these two contrasting cases really drive home the point that picking the right companies is just one part of the equation. Knowing when to hold them and when to let them go is equally important.
It's a reminder that even in a market that generates a significant amount of wealth overall, there are winners and losers. And those informed buy and sell decisions require careful analysis and a real understanding of a company's long-term prospects. But before we get too into the weeds of individual company analysis, I think there's one more aspect of this research that's super relevant. especially given all the rapid technological advancement we've seen recently.
Yeah, you're right. The data only goes up to 2020.
Right.
And a lot has changed since then. We've seen the rise of AI blockchain, the metaverse, a whole bunch of other groundbreaking technologies that are changing industries and creating these entirely new markets. So how is that going to impact the concentration of wealth creation going forward?
Yeah, that's a great question. Will these technological shifts create a new wave of superstar companies, maybe disrupt some of the existing giants? Or will companies like Apple, Microsoft, and Amazon continue to dominate? Let's explore that as we continue this deep dive.
Yeah, it really is fascinating to think about how this landscape of wealth creation could shift in the next few years. I mean, we've seen the power of disruption time and again. Think about the rise of the internet and how it created these brand new industries and totally upended traditional ones. So are we maybe like on the verge of another one of these major
Yeah,
realignments?
it's definitely possible. The research that we've been looking at really highlights that long-term value creation is what drives those superstar returns. So the big question is, which companies are going to be in the best position to actually create value in this new evolving technological world? Is it going to be those big established companies, the ones that can leverage their huge resources to really dominate these new and emerging fields? Or are we going to see those super nimble startups kind of disrupt the status quo, just like Amazon and Google did during the dot-com boom? Yeah. It's almost like this high-stakes race.
Mhm.
You got these huge companies like Apple and Microsoft pouring tons of money into things like AI and blockchain and all this other cutting-edge technology. But at the same time, you have these startups popping up all over with game-changing ideas. It's really anyone's guess who's going to emerge as the leader in the next decade.
Yeah. And what's so interesting is that both scenarios could actually be great opportunities for investors. If you think the established players are going to maintain their power, then investing in them could be a way to grab a piece of that growth in these new markets. But if you think disruption is going to happen, then finding those promising startups early on could give you even better returns.
Like that old saying, during a gold rush, sell shovels.
Yeah.
Instead of trying to find gold ourselves by like picking the next big thing, maybe we should be looking at those companies that are providing the tools and the infrastructure that these new technologies need to grow.
Yeah, that's a great analogy. It shows how important it is to think past the hype and look at the real underlying value. Instead of getting all wrapped up in how cool a specific technology is, investors should be asking themselves, which companies are building those must-have products and services that will really help these new technologies succeed? Because those are the companies that are probably going to be creating lasting value no matter which technologies actually end up winning.
So what are some of the big takeaways for our listeners as they try to figure all this out? What should those professional investors be thinking about when they're getting their portfolios ready for what's next?
Well, I think first and foremost, it's important to remember that this concentration of wealth creation that we've been talking about is probably going to stick around. A small group of companies are going to continue to drive most of the market returns. And of course, the challenge is figuring out which ones those are going to be. The research suggests that looking at how those returns are distributed, especially the idea of skewness, can be really helpful. Companies with that potential for those lottery-like returns often have more ups and downs in their stock price in the short term.
Right. But as we said before, volatility isn't everything. It's about finding the companies that are not just volatile, but they're disrupting industries, coming up with amazing innovations and building something that will last. It's tempting to go after the hottest trends, but it's really important to do your homework to understand how their business works and to make decisions that are based on what will create value over a long period of time.
Exactly. Don't let that fear of missing out make you do something you'll regret. Remember, being a successful investor isn't about trying to perfectly time the market. It's about making smart choices and having the patience to stick with those investments for the long haul.
This deep dive has been really insightful. We've talked about a lot today. We started with that surprising finding that most individual stocks actually underperform. Then we talked about how a small group of companies create most of the wealth. We looked at what that means for passive versus active investing. And we discussed how all these new technologies might totally change investing in the years ahead.
Yeah. As we wrap things up, I would encourage everyone listening to keep thinking about all this. Don't be afraid to challenge what you think. Dig a little deeper into the research, and most importantly, think about how you can use what we talked about today in your own investment strategies.
That's a great way to put it. Thanks for joining us for this deep dive. And until next time, stay curious, stay informed, and happy investing.